Nigeria's headline inflation eased to 22.22% in June 2025, down from 22.97% in May, marking the third consecutive month decline. The drop announced by the National Bureau of Statistics ahead of the 301st Monetary Policy Committee meeting, scheduled for July 21st to 22nd, has renewed debates over whether the Central Bank of Nigeria will maintain its current 27.5% benchmark rate or initiate a marginal cut. Analysts cite exchange rate stability, improved macroeconomic indicators, and lower PMS prices as reasons for positive monetary easing. However, risks like food supply shocks and global uncertainties may prompt a hold. CBN Governor Olayemi Cardoso reiterated the Apex Bank's goal of achieving single-digit inflation and stabilizing the naira. We have joining us in the studio Oreoluwa Odetunde, Head Research, Anchoria, Asset Management. Thank you for joining us.
Thank you for having me.
Good morning to you. So, 3 consecutive months of easing in inflation. What are we doing right? Or is this just previous lag-on effects that are now trickling down? Oh, okay, what's happening?
Exactly.
Okay.
So it's really like you said, it's previous lag-on effects. It was a statistical effect. Recall that we rebased our inflation in 2024. And remember that we had significant pressure points in 2024. PMS prices increased by close to about 80% in 2024. Right. And also the exchange rate depreciated by an average of around 30%. So there were significant pressure points. So this year, now we have a new base year of 2024. This year, inflation is still rising, but compared to last year, it is, somewhat falling. So when the pace is somewhat falling. So when you now look at the CPI figures, the high base of last year and like this current CPI figures that we are having, it appears that inflation is slowing down. Even when we didn't necessarily see a decline in the food and the core index as well, because we still saw pressure points on both ends. It appears that
it's slowing down. So from what you're saying, it's just the figures that are changing.
Yes, it's just the figures.
Pretty much. Inflation target we know is 15% for 2025. Right now we're in July, we're at 22.2%. Do you see us meeting up with that target with the way things are going?
Yes, I think our expectation really is that inflation should continue to make its way down, headline inflation, largely due to a base effect issue. But we still expect pressure points from the food index as well as the core index as well.
And that's
but
because...
we do still... Yes. Okay. So for the food index, we still see, factors like, the seasonal, the planting activities, which is expected to peak within June and September. That, usually increases during that period. So that definitely affects, the farm produce index. We've started to see some form of acceleration in the farm produce index when you see the inflation numbers. Another thing you also want to consider is the fact that, FX demand tends to be high in the third quarter. People are, usually traveling, all of those kind of things. And, yes, speculative activities are somewhat, reduced, but we still think that there will be some pressure points on the FX index. And lately, we started to see that there's some pressure on the transportation index. So last year, most of what drove the higher transportation index was, higher energy costs. But we've now seen that, energy prices have stabilized. But one thing that we noted that continues to still drive this higher transportation index is the fact that we still see insecurity, especially in the Middle Belt region, which was what affected food inflation for the month of June. Another thing we also want to consider is the fact that our infrastructure, in terms of our road networks, that really remains poor. So we recorded a negative growth in the transportation index for May 2025 was about 0.3%. But what we noticed for June 2025 was that index actually accelerated to around 2.64%. So to say, we are seeing pressure from the transportation side. We are also seeing pressure from the food side, which we expect would also continue. But on a headline basis, we still think that that high base effect is what is going to make inflation trend downwards. I don't think we'd necessarily need that 15% target, but I think that getting into the ember periods where we have September-October period, remember that around that time PMS prices soared to over 1,000 naira. So now we've seen PMS prices stabilize. It would also, put some downward pressure on, that inflation figure that we should see. So I think our general forecast is, at the end of Q3, Q4, inflation should be hitting, on an average basis, somewhere around 24%. We think that it will trend below 20%, at the end of the third quarter due to the pressure points that we saw for last year. But we think that, there was a significant rebasing for the December 2024 inflation figure, where inflation fell to as low as 15.4%. But I think that, because of that, we might likely see a spike in the December 2025 figures. But all in all, we still expect that inflation should come down to around 22% levels on an average basis in 2025.
15. So we still have some quite a way to go. We're going to get into, because you've said so much, and I'm sure all these elements will inform decision making in the next 2 days of the MPC. But we'll get into that after this break. Stay with us. Right, you're watching Business Edge. We are talking inflation and the ongoing MPC meeting. We have Oreoluwa Odetunde joining us from Anchoria Asset Management. You have given us quite some detail as per the indicators that are informing where inflation is at and the proposed trend. And there's so much to be considered when it comes to decision making in the next 2 days. You've mentioned quite a lot going on with food prices, infrastructure. And then there's also a survey that was done recently. 62.4% of respondents expressed they preferred that rates be reduced. There are people who are pointing at our FX situation. We're seeing some stability, projected appreciation of the naira, PMS, we're meeting our output, right? So, I mean, who should the MPC committee be, who should they be listening to at the moment?
I think what we've seen about this particular MPC, this central bank's MPC, is that they tend to be very data dependent. So I think they'll be focusing a lot on the data that we've been getting recently, especially the leading economic indicators. So such that we've earlier discussed, we do expect, and we know that recently the central bank has changed its focus. It's now moved from an exchange rate targeting to an inflation rate targeting, which means that there's less focus on trying to control exchange rates and more focus on trying to control inflation. So I think that it will be basing its decision not only on the current inflation data that we're seeing, but on inflation expectations. So where does inflation expectations land us? We know that we're still seeing pressure points from the food index as well as the core index. Apart from that, leading economic indicators like the purchasing managers index is showing that input prices are accelerating faster than output prices, which means along the line we'll start to see that higher cost of production being passed on from producers to consumers. So we do expect prices of things to still keep going upwards. And also we've seen the money supply data that still is very close to its peak of around 118 trillion. So when you have all of this data, it still continues to show that there still needs to be more. There's probably still need to keep interest rates at this current level in order to still bring about more price stability. And another thing we would also want to consider is the fact that 60% of our budget is dependent on the oil sector performance. One thing we've seen definitely is that oil prices have been volatile, but the general trend is expected that oil prices should be lower in 2025. I think some forecasters is that oil prices should fall below $60 per barrel, and we know that in terms of production target, we aren't yet meeting that 2.1 million barrels per day projection according to the federal government. So we should have a revenue shortfall, which means that most likely the government will still have to increase borrowing. So we might most likely see a supplementary budget sometime later this year. So that should also have effect on inflation. And we know that generally we still see insecurity pressures that is still affecting the food basket. So when you look at all of these considerations, you still see that we still expect significant pressure points later in the future in 2025. So the CBN MPC still needs to hold in order to establish some trend that inflation is coming down much more sustainably before it starts to cut interest rates.
So another hold.
Yes, another hold decision.
Perhaps. Yeah, and I've heard analysts in previous months say one of the things that has informed the hold is uncertainties. Part of it has been geopolitical uncertainties, looking at what's happening on the global scene. Do you see some sort of stability? A lot of that uncertainty, of course, was caused by Trump, right? And, what he was saying, the threats of his tariffs. And then there are those who are saying, Trump, it's just mouth, right? he just wants to get deals out of it. But he has this on and off, I'm going to do that.
And it makes the markets very
postpone it. But then what we're seeing now, right, is markets are perhaps not as much taking him for his word and are proving to be a lot more resilient, right, and not necessarily reacting to it. So do you see that in a way also shaping decision making, locally?
So I think locally, I mean, one thing we would want to consider is that, foreign investors have actually exited our market significantly, especially between 2020 to 2022 period. But we started to see that due to the significant FX reforms in the markets and, stabilization of some of the policies, they're starting to make their way back into the economy. And one thing you want to consider is that, in the global space, there's some sentiment amongst, global portfolio managers that, U.S. assets, developed market assets are actually becoming quite overvalued. So they're looking elsewhere, they're looking to other investment destinations,
markets, right.
exactly, in order to, gain that significant upside potential. And, I think that is what is going to continue to prompt the MPC to keep interest rates high so that they can continue to attract that foreign capital into the Nigerian economy. So, we've definitely seen, we've seen other, central banks keep, interest rates. They've started to reduce their interest rates, so to say. But we see that, for the US, it still continues to keep interest rates high due to the tariff uncertainty. But also another thing you want to consider is the fact that we haven't yet necessarily seen weakness in their hard data. So in terms of their soft data, in terms of things like their consumer surveys, inflation expectations and all of those things, they've been quite weak. But when you now look at hard data in terms of GDP and inflation, you see that it's in line with, forecast of a lot of analysts. So, if you look at the economy, the US economy still appears quite strong. So they most likely need to keep interest rates at those levels. For us, the data still appears quite mixed. So we need to see, a particular trend that shows us that, the central bank is comfortable with this position that, the country is in, the economy is in, and can start to cause interest rates to follow up with,
I was going to get to, finally, before I let you go, the trade-off with keeping rates where they are. Yes, it's a comfortable position to be in to continue to attract FPIs, but the real economy, the real sector, how it's being impacted by these higher interest rates, what do you make of that trade-off?
So I think they first need to achieve price stability before we can start to see them drop interest rates. Because you would see that if they start to drop interest rates quickly, or they, I would say, move ahead of the curve, you'd see that money supply would increase, would have too much money chasing too few goods, and inflation will start to reaccelerate once more. So they need to bring about some level of price stability, because you would see that if they cut interest rates, will still growth will, the economic growth will start to increase and all of that, but it will be eroded by inflationary pressures. So we need to make sure that inflation is relatively low or relatively sustainable before they can start to say, oh, they want to cut interest rates, so to say. So if you look at it on a real terms, we still need to record positive real returns, positive real GDP. But currently we are not necessarily doing that due to the high inflationary pressures.
Right. Thank you so much. A lot to digest there. Oreoluwa Odetunde, Head Research, Anchoria Asset Management. We'll see how the decision pans out in the coming days, but thank you for your time.
Thank you for having me.